I'm David Lewis, partner at DLA Piper in our Phoenix office here. I'm a corporate securities attorney, and I head our education practice group. To my immediate left is Itai Naveau, DLA partner in the Boston office. Itai focuses on representing representing emerging and mature technology companies and venture capital, growth equity, and private equity investors in those transactions. To Itai's left is Ian Westberg. Ian's a co-founder and West Coast manager for the Venture Pipeline. That's a DLA affiliate that actively advises companies on strategic business issues critical to capital raising. And in that role, Ian advises companies on various aspects of their business plans, including capital structure, management, recruiting issues, strategic partnerships, and financing strategies. And at the far end there is Richard Grant. Richard's a senior associate at Comcast Ventures. And there he's responsible for identifying, evaluating, and executing new investments, as well as supporting Comcast Ventures portfolio companies on their strategy and business development issues. He also heads their investment activities in the education sector. So I'm going to jump right into it and start with Ian. So, Ian, in your role at the Venture Pipeline, you see literally hundreds of potential deals a year throughout, DLA nationwide. And a lot of these companies are starting the process of trying to decide whether they ought to seek outside capital. So we know that timing can mean everything in those efforts. So from your vantage point, what can you tell us about how a company can determine if it's the right time to go out and seek capital?
Okay, thanks, David. I think the first thing that companies have to do is they have to look at their business and say, does my model fit the venture capital model in terms of growth potential, returns? And there was a TechCrunch article that came out here recently that discussed the fact that there were 2,100 private company acquisitions that happened in 2012 for more than $40 billion in liquidity. And of those 2,100 companies, 76% had not raised venture capital. So there's a lot of businesses where the venture capital model just doesn't fit. And so I think first and foremost is understanding where your company fits in the model. And Lynda.com was a perfect example. They just recently raised a round of $100 million, but prior to that company was bootstrapped and grew a tremendous amount without ever raising capital. And I think Bill Gurley last night said it best. I mean, this is a huge commitment that companies take on, and I used to always refer to it as a marriage. I like the way that he described it better. It's really like having a baby. I mean, once the VC's on the cap table, they're gonna be there for a while. It may not be 18 years, but they're gonna be there for a while. And so I think the timing is right when you have taken a look at your company from the venture perspective and covered off some key issues. First being team, that you have the players in place from a founding standpoint, from advisors, board members. You've surrounded the company with the right talent, because all investors will tell you that they invest in teams, not technology. That you've figured out the technology risk associated with your product, that you've gone out there, that you've talked to clients, you've got it in the market, whether it just be a beta or with paying customers. That you understand the market opportunity, your competitors, and are really seen as an expert in the space. And then lastly, I think, and I've seen companies that had all of those other things aligned, but until you know the sales model, I think in the ed tech space, this is extremely important, is understanding how you're going to sell this into the market. And ed tech, when you're selling to schools and you're selling to districts, that model can be painfully long, and that's one of the big reasons that the VCs have shied away from ed tech up until this point.
So, Rich, you're the one up on this panel that actually invests the money. So is there any part of Ian's answer you want to focus in on as far as what you're looking for a company that's ready or not?
Yeah, I mean, I certainly want to draft out what Ian was saying. I mean, certainly not every company is necessarily needs to seek venture capital funding. Every situation is unique and different, and you need to think through that. When I think about institutional venture capital and sort of what we're looking for, it's a lot of what Ian was saying. We're almost fuel to a fire that you've already started, and we can add to that fire. We can help it grow through our relationships, through our sort of mentorship and guidance at the board level, and then certainly through the capital that we can help to propel the business. And that's probably the most sort of straightforward venture investment is you get that company to a place where you understand your distribution models, you have a product in the market, and you've answered the really big questions, and you're really using the capital to kind of expand. You've seen another trend in the market, which is kind of the antithesis of what you saw with Linda, where I've seen enough movies to know that gasoline can be sort of an igniter for a really big disruptive fire. And you've seen some companies come out of the gate very early and raise significant amounts of money, 15, 20, $25 million, because they have a very disruptive concept. They want to plant a flag in the ground and really stake out that opportunity, and they know they'll need capital in order to do that and create the mind share. And I think that's sort of the definition of a venture bet in many ways, and you are seeing that, and that's sort of the other end of the spectrum, where you have to have a visionary leader and somebody who can really sell that concept in. You have to find the right investor who buys into that concept and believes in it and is willing to put a significant amount of capital behind it.
And so Itai, if you're like me, you have a number of clients across the spectrum of companies that are ready for funding versus not ready. And when you have that heart-to-heart talk with them and you guys decide that they're not ready, what are some of the other options you see your clients taking or that you advise them to take a look at if they aren't ready for that institutional stage yet?
So it really kind of depends on where they're going. I'm just curious. So in this room, how many people are entrepreneurs? So call it 60, 70%. And how many of you are, will you consider yourself startup entrepreneurs? Early stage, kind of pre-funded. Okay. So I guess I think it really depends on where you want your company to go. And if you think that venture funding is what is needed for your business, then you start looking at angel opportunities and see if you can raise money that way. And most companies will go through some kind of a friends and family round and then reach out to angel investors. If they have the ability, they'll reach out to institutional type angel investors. Some companies are not in a position to do that. They'll reach out to accelerators to try and get a little further along to improve their ability to raise capital. And some companies are trying to bootstrap and avoid raising institutional money because that isn't what they need, and they can delay the fundraising process from an institutional perspective until later, and that often can translate into improved valuations at the time, and you're effectively giving up a smaller chunk of your company. So you've got, you can reach out to angels, you can reach out to accelerators and get some level of funding and some mentorship and some other free goodies, and kind of delay your fundraising. You may partner with customers. You may use. I've seen companies in the edtech space turn to customers, in effect, trying to get NRE money. Development projects, partnerships, and try and use that money to organically grow.
And just to add to that a little bit, I mean, being an entrepreneur is about being tenacious and finding solutions to problems. And there is this chicken or egg scenario that just about every company I work with goes through.
Yeah.
I need the money to grow the business, and I need to grow the business to get the money. And it comes down to finding people that believe your vision, selling them, whether it be programmers, whether it be other business people, to join the team, the revolution, and those are the first people that you're selling. And if you can't sell to those people to join the team, then you're probably going to have a really hard time selling to professional investors.
I think it's a great point. I think it really kind of depends on what company you have, where you are in terms of development. Do you need the money to, are you worried about competitors coming into your space? So you need the money to move more quickly to really protect your baby. And it's also important to remember that I think I don't remember the stat was, you said 76% of companies don't take.
76%.
So a lot of those companies grow and get to the point where they'll take growth money, or and there's more and more of that happening. And a lot of that money can come from VCs who are moving up market and are providing that growth money as opposed to seed money or Series A money. And the terms of those deals are different and a lot of times more attractive to founders because there's some measure of liquidity in those deals. So it really depends on what it is that you need to succeed, where you are in development.
So following up on that, I mean, one of the questions I hear sometimes from companies is why not get on the radar screen of investors, even when it may be the case that they're not ready yet. So are there any consequences to that decision in terms of going before you're ready?
Yes. And just to tell a quick story, I had a company come in, and it was a med device company, and the founder hired what he thought was a seasoned CFO to come in and help with the fundraising. And while the CFO was experienced, she wasn't experienced in raising capital for an early stage med device company, which this was. So I start working with this company. I find out that the CFO had contacted basically every fund in the space. And not only had she contacted them by email,
Sure,
she had sent a hard copy of the full business plan via mail and followed up with a phone call and a voicemail. And so, that company was essentially dead in the water with the market because they completely overshot themselves. Now that's an extreme example, and I think that if you're questioning whether or not it's the right time to go out, you can test the waters. And I tell clients all the time, there's value in that process. So going to a couple of what we call friendlies, getting feedback, understanding because if you're in a hot space, VCs are a lot more forgiving and will pay attention and will take meetings, and a lot of time will fund companies that are earlier than they typically invest. So my advice is to take the process in a staged approach and learn from every step in that process, and definitely do not overshop and do not send to every VC in the market.
So over to Rich. I mean, as far as the ed sector itself, and since you're the lead on Comcast Ventures in this space, I mean, is there anything unique about companies in this sector, or even ed tech companies in particular, that make it different from the other companies you see outside education?
I mean, it's certainly a nuanced industry. There's a lot of different regulatory bodies or various players that have become incumbents in the spaces that impact it. But generally, I look at the space being very similar to others. One of the key differentiators, though, is the fact that the investor base is almost sort of there's two pools of investors that you can think about when you're looking to raise money. You've got the endemic investors who are out there and have a lot of experience in this space, and then you've got sort of the multi-category funds like Comcast Ventures, where education is a component, but they're also looking at a number of other categories. And I think at a very early stage, to your point, you can get a lot of benefit from working with those endemic investors, because they have the knowledge, they've seen different cycles in the space, and they have a relationship network that can be extremely valuable to that early stage company just trying to get off the ground. I think as you grow and expand, then and particularly as you start to seek more capital, a lot of these education-focused funds tend to be smaller funds relative to the multi-category funds that are quite large. So as you need more capital to grow the business, as you encounter problems that or issues or what have you that can be very analogous to other spaces, and if you want to diversify your network, I think that that group of multi-category investors can become pretty attractive at that next step to help grow the business. One thing to be aware of when you sort of go down that path, though, is the fact that you may be working with somebody, you're likely working with somebody who has a pretty good understanding of your space when you're talking to the partner who focuses on education investments. The other, 5, 6, 8 partners around the table all have gone to school and have an opinion about, what should happen in the education system. They haven't necessarily been up to date on the trends and the companies and the players. And so it does require, more work and, no pun intended, more education, to sort of get them up to speed.
That's a great point. I think that, so when you're out there raising money, VC or otherwise, to the extent you can raise money, position yourself to raise money from people who understand what your business does or understand your market or have, who can help you beyond just providing the capital that you're seeking. That A, makes your conversation a lot better. B, means that they're going to be a lot more useful to you and lower the beta on, lower the risk factor associated with taking money. It also is a great way to distinguish one investor from another. Are they just money or is it more value add? It goes to talking to investors too early too. If you're engaging in a conversation about the market but not asking for money, which is not to say that you shouldn't say, well, we'll be out raising, but you don't have to have that conversation today. You can have an informed conversation about the market, get their perspective on, consumer versus not, or, whatever is relevant to your particular business. And then a couple months down the road, you have a shared, base, you have a relationship with them. It makes the fundraising process totally different.
I mean, that's a great point just in terms of VC it's a very small community. It's very relationship driven. So, focusing on friendlies early and starting to develop a broader base of folks that you have a relationship with is incredibly important as you start to go out and raise in the future.
And the same is true for growth investors. The same is true for customers. The same is true for, it's particularly true in the VC space, but it's always true.
All right, so let's shift a little bit here. I want to ask a question which I'm going to open up to the three of you about incubators and accelerators. I sat in on a panel earlier this morning that talked about them. I see fellow board member here, Patrick, and I are on the board of an incubator here in Phoenix. And I'm curious, when you have a company go through an incubator, I mean, do you see material improvement in this company? What do you see those doing for companies when you meet up with them after they've gone through? And do you view that as something that's a viable and good alternative for some companies?
I think, yeah, absolutely. And obviously not all incubators and accelerators are created equal. And I think finding one, back to Itai's point, that is in your space, that understands the issues, that has the connections that are going to help you grow your company, mentors with that have grown companies in the space. I saw a statistic on Imagine K-12 that 70% of the companies that have gone through their program have raised capital, which I just thought that was incredible. And a lot of these incubators partner with VCs, and so you have that avenue directly into a capital source once you graduate the program, which is extremely valuable.
Yeah, I mean, we at Compass Ventures, we've been very supportive of accelerator programs broadly. We've partnered with DreamIt around a minority entrepreneurship program or track. We've worked with Seed Start in New York as well around a media one a couple years ago. We've also invested in companies that have come out of a host of these, not necessarily always coming directly out of the program, but it's a great way to sort of see a new crop of companies that are popping up, and you recognize that they're getting access to a tremendous amount of resources, which I think, particularly in the education sector, I'm really excited about all the growth in these accelerator programs, because, and Imagine K-12, the guys talk about this quite a bit, but education is a sector that brings together engineers who have never really worked in education, but they want to make a difference, and educators who don't really have the technical know-how to build product, but they realize they want to change the system too. And Imagine K-12 is a place, and these other accelerator programs are a place where you can marry those two, groups of folks and create some really interesting products and teams and companies. And then the other aspect is just the mentorship and the connections. This is a space that, everybody seems to know everybody, and it can be really valuable to learn from the mistakes and the successes of those who've come before you. If you hadn't come from the space historically, it's really valuable to get that mentorship, I think, here in the education space in particular.
Most companies I see pivot a lot. So, they get a couple of pivots done before they go out to the VCs or other investors, and it's very helpful. Their mission gets refined, they got a better focus on, not all accelerators are good, and some of them are, I've seen ones that are really about the money or about the equity stake and not really about providing great mentorship. But the
A
good,
lot of real estate plays out there.
yeah.
Well, on that point for a company, I mean, what should they be looking for if they're have an opportunity to go into one of these in terms of telling the good ones from the ones that are out for as a real estate play or for their 6% for 10,000 or
You do
whatever?
your diligence.
Yeah,
You
yeah.
talk to companies that have been through the program. That's the best way to vet these, and figure out what their experience is and what the success rate of the accelerator has been.
And talk to your advisors. Most. If you have a friendly VC, ask them. If you have a lawyer, ask them. The odds are they've seen people come out of the programs, and then you go and you meet and you see what the feel is like, and it's good to apply, and then you can get and also the ones that are sector specific as opposed to very broad tend to be helpful if you are clear on where it is you want to go.
The big risk here, and only time will tell, is that so many of these accelerator programs have just been launched, so they don't really have classes. They'll sort of be learning as you go, or learning as they go, along with the first crop of companies going through the programs. And then the other issue that you've seen, not necessarily in education yet, but in other spaces where you've had an onslaught of accelerator programs start, is it dilutes, kind of the quality of the companies that are coming out. Y Combinator is actually lowering the size of the classes that they're putting out, just because they don't want to have sort of dilution in the quality of the companies, because at the end of the day, all these accelerator programs and incubators will be defined by their successes and failures.
So quick question for you, Rich. I know I'm not supposed to be the
Uh-oh.
one asking the questions, but there's a lot of talk between this seed Series A gap. And I'm a believer that the accelerators have a lot to do with that, just because of the volume of companies that they're putting through the programs. I would be interested in your opinion if that's part of that, at least part of that gap.
It's possibly, although most of those companies coming out of these programs are raising seed money, I think that the bigger challenge has been there's just a tremendous amount of sources for capital at early stage, whether it's angels, dedicated seed funds, or even venture funds that are sort of making a lot of sort of seed bets and sort of seeing where the chips fall. So, and it's much cheaper to, or requires a lot less capital to start a company these days. So you just have a tremendous amount of volume. I think maybe in part the accelerators are contributing to that, but I wouldn't blame the Series A crunch on them.
I guess we have about a minute for a question or two, if anyone has one for the panel here.
I was wondering if you could comment on your experience or your thoughts on crowdsourcing, crowdfunding.
That's funny.
That was one we had on there that we didn't get to.
Yeah. I'm, the 1 minute answer is I'm not a fan. This is my personal perspective. I would, so it's certainly one of the options we talk through with clients. I would rank that as one of the lower options on the list.
Why?
You end up with, a lot of stockholders that limits your ability to do things going forward. In various cases, there may be, depending on how you do it, they may have securities law implications and things like that that hamstring you down the road. It also means something about, there's other ways, particularly if you're in the ed space these days, there are other ways of raising capital, and so that there's a signal there. If you're resorting to crowdsourcing and angels and customers and partnerships and VCs and accelerators, and all of those things are not, or angel list, if all of those things are not available to you, I think before you go out to the anonymous internet, you pause and you say, well, why is that? What is the information that I'm getting from the market about fundraising? So it's not a no, it's just, I would rank it lower on the list.
And on the VC side, I mean, certainly capital is one of the aspects that you receive from an investor, whether it's an angel investor or an institutional VC. But there's a lot of other aspects that aren't defined necessarily by just the capital, whether it's the network and the relationships that those investors have collectively at that firm, the advice and the perspective having either invested in similar companies or analogous companies. So, at least. And then on the corporate side, having a corporate partner like a Comcast or an NBC Universal that could be a big customer or a distribution channel for you in certain circumstances, also another sort of point of value and differentiation, and one in which we sort of at least try to justify kind of the value that we can bring above and beyond just the dollars.
We for what it's worth, just completely anecdotally, I haven't done the research, but I can't think of a single VC investment into a company that's been crowdfunded.
I don't know.
So it kind of,
It's possible. I don't
yeah.
It's possible, yeah, but
I don't know if that's actually, I assume that it's happened, but there are significant limitations.
All right, I think it's time for the next crew up here.
great.
Thanks.